Hello and welcome. Today, we are going on a quest to answer a huge question in the world of finance. What is something really worth? We're going to dive deep into the world of valuation and unpack the massive difference between the price tag you see and the actual value you get. So let's just jump right in. You will see prices for everything, right? A stock, a car, a whole company. But is that number, that price, the real story? Is that its true value? Well, the short answer is nope, not always. And you know what? Understanding that gap is pretty much the secret to smart investing. And it all boils down to this really simple but incredibly powerful distinction. Price, well, price is just a fact. It's the number on the screen, what you pay right now. But value? Value is something else entirely. It's an educated guess, an estimate of what an asset is truly worth based on what it can do for you in the future. And believe me, those two numbers are often very, very different. So here's the game plan for today. First, we'll look at that big battle between price and value. Then we'll explore the different kinds of value, because it's not just one thing. After that, we'll walk through the three main ways analysts figure all this out, put it into a bigger context, and then wrap it all up with a real-world example. Sound good? Let's go. Okay, so this right here, this is the absolute heart of an investor strategy. The whole point of being an active investor is to figure out an asset's true value and then hold it up against its current market price. That little gap between the two, that's where all the opportunity is hiding. And it leads to these three simple rules that really guide every decision. If your homework shows the value is way higher than the price, what do? You buy. It's on sale. If your value calculation comes in lower than the price, you sell. It's overvalued. And if they match up perfectly, well, the market got it right, so you just hold your ground. All right, let's build on that. Because, when we say the word value, it's not actually one single thing. It kind of has several different flavors, and analysts will use a specific one depending on what they're trying to figure out. First up, you've got fair market value. This is probably the one that makes the most common sense. Just picture it. You have a buyer who's ready to buy but not desperate, and a seller who's ready to sell but isn't being forced to. They both know all the facts and they agree on a price. Boom, that's fair market value. Then there's book value. Think of this as the on-paper value of a company. It's pure accounting. You just take everything the company owns, all its assets, and you subtract everything it owes, all its liabilities. The key thing to remember is that this is all based on what things cost in the past, not what they're worth today or tomorrow. Now this is the holy grail for investors, intrinsic value. This has nothing to do with the past. It's all about the future. It's trying to figure out what an asset is worth based on all the cash it's going to spit out for the rest of its life. And, crucially, you have to take all that future money and discount it to figure out what it's worth in your pocket today. And finally, we have liquidation value. I like to call this the breakup value. It answers the question, what if we just shut this company down today and sold everything off piece by piece? The computers, the factory, the desks, everything. Sometimes a company can actually be worth more dead than alive. And this is the number that tells you if that's the case. So that's a lot of different kinds of value, right? So how on earth do analysts actually come up with these numbers? Well, they've got a toolkit. And in that toolkit, there are three main paths they can take to get to an answer. And these are the big three: the income approach, the market approach, and the asset approach. You can think of them like three different maps, and if you use them right, they should all lead you to the same buried treasure, the true value of the business. The income approach is all about looking into a crystal ball. It tries to calculate that intrinsic value we talked about by forecasting all the future cash a company is going to make. Then it does that magic trick called discounting. Because let's be real, a dollar you're promised in 10 years is worth less than a dollar you have right now. And this quote really just nails the whole idea. When you buy a stock or any investment, what you're really buying is a stream of future benefits, of future cash. The income approach is just the tool that puts a price tag on that entire stream, right here, right now. Now, the market approach is way more straightforward. It's actually a lot like valuing a house. How do you figure out what your house is worth? Well, you look at what similar houses on your street sold for recently, right? It's the same idea here. You find similar public companies and you compare them using key stats like the price to earnings ratio. Simple as that. And the third path is the asset approach. This is what we call a sum of the parts method. It basically asks, if we had to rebuild this exact company from scratch today, what would it cost? So you add up the fair market value of all its stuff, you subtract all its debts, and whatever's left over, that's your value. But here's a really important point. A great valuation doesn't happen in a vacuum. You can't just look at a company with blinders on, because its value is massively influenced by the world around it. A smart analyst knows they have to zoom out and look at the whole big picture. And they do this using what's called the EIC, or top-down approach. First, you analyze the entire economy. How's it doing? Then you zoom into the specific industry. Is it growing or shrinking? And only then, after all that, do you finally analyze the individual company. It's a fantastic framework because it stops you from making a classic mistake, falling in love with a great company that's trapped in a dying industry. And here's the thing you have to realize. Figuring out a company's value isn't some one-and-done calculation that you can just stick on the fridge. No, it's a living, breathing process. It's dynamic. Just look at this feedback loop. New information is always coming in. An earnings report, a new competitor, a change in interest rates. That new info forces investors to recalculate their estimate of the intrinsic value. That, in turn, creates pressure to buy or sell, which moves the market price. And then the whole cycle starts all over again. It truly never stops. Okay. That was a lot of theory. So let's try to make this all feel a bit more real with a super clear example, valuing a simple bond. This is really going to hammer home those ideas of future cash flow and present value. Okay, so let's meet Bond B. It has a face value of 1,000 rupees. It pays out a 6% coupon, so that's 60 rupees a year, and it has 5 years left until it matures. But, and this is the most important part, similar new bonds being sold on the market today are paying a much better rate of 10%. So, what's our old 6% bond worth in today's 10% world? Well, when we run the numbers and discount all its future payments at that current market rate, we find its intrinsic value is only about 847 rupees. Now, why isn't it worth the full 1,000? Well, think about it. Why would anyone pay you $1,000 for a 6% return when they can go next door and get a 10% return for the same price? They wouldn't. The price has to fall to make the overall deal competitive. This shows that dynamic between value, price, and the market perfectly. So we'll leave you with this one question to think about. Now that you know the difference, when you look at the market, what are you doing? Are you just reacting to prices, chasing them up and down? Or are you taking a moment to really understand the true underlying value of what you're buying? The answer to that question could really make all the difference.